the Federal Reserve has announced it is raising interest rates once again in an ongoing effort to combat high inflation.
Today's rate increase marks the 10th consecutive hike since March of last year, and the central bank is increasing interest rates as expected by 1/4 percentage point, otherwise discussed as 25 basis points. The move boosts the Federal Reserve's benchmark borrowing rate to its highest level in 16 years.
This has very large implications. So joining us now here in Studio 57 is Javier David. He's a CBS News contributor and managing editor for business and markets for Axios. And on your screen, you also see CBS News chief Washington correspondent Major Garrett, both of you here to help us understand what just happened and what comes next. Javier, let's begin with you. This is the number widely expected. How will it impact viewers watching and their financial picture this summer?
Right. So the big thing here is that what all of us have been looking for is whether the Fed is sort of one and done. Like this is this the end of this particular phase of the tightening cycle? And it seems to believe they've kind of opened the door, but I think they don't want to appear as if they're pulling back because inflation is price. Look, it's price stability. They're central bankers. It's all about maintaining price stability. And for investors or consumers, rather, it means that if they stop, there's a little bit of sort of breathing room that they'll get on a lot of the borrowing costs that they've seen skyrocket, particularly credit cards, particularly mortgage rates. If you're a new person who wants to go buy a home for the first time, 7% interest rates, not, certainly not favorable in terms of what you would expect.
And so if the Fed, just to clarify what you're saying there, Javier, if the Fed then says, this is it for a while, those rates are expected to come down slightly, or they'll maintain?
They'll just remain where they are. And I think that the way forward is whether rates stay where they are, does inflation continue to sort of pull back? Because we've got what we think is a little bit of slack finally in the labor market, because that's been the key to all of this. People have jobs, plentiful jobs. They're spending more. Wages are going up. But it seems as all of that is starting to moderate, but still at pretty high levels.
And Major, this is now the 10th interest rate hike that has taken place during President Biden's time in office. The Federal Reserve, as we know, is a separate entity from the White House, but perception, as you well know, matters in politics. So to what extent does this impact how Americans perceive the president and his handling of the economy?
Well, it's a downstream perception. However, this particular rate hike affects their lives personally, they'll factor that in. That's always been the case of American voters judging the economy and the president when the economy is either positive or, from their vantage point, negative. And as Javier said, this 25 basis point rate hike was sort of baked into the cake of expectations. But I wouldn't say that it is a perfectly neutral or benign rate hike, because it will have effects on regional banks. It will make their borrowing authority and their financial viability a little bit more stressed. And regional banks have, for the last 2 or 3 weeks, been among the most stressed financial institutions in this country. Stressed regional banks provide less available lending in their region. That will also affect people, and that will affect the economy in that region. And so this rate hike, though it does suggest this may be the end, might be the 10th and last for a period of time, isn't exactly a neutral economic or political move.
And Major, we're not out of the woods yet. So in some ways, as much as things may have changed with the stress on regional banks, things are still the same. The Fed continues to inch up now and getting the Fed funds rate now above 5%. So what does that tell our viewers about the state of the economy, that while the Fed may be indicating the last phase of hikes, as Javier said, but that it's still doing it, what does that show our viewers?
So the language that the Fed accompanies this rate hike with will matter a great deal, not just to investors, but those who are trying to estimate what the Federal Reserve's perception of future economic developments in this country are. And there's this enormous question going on, as Javier well knows, probably much better than I do, among economists. Is a recession inevitable? Is the psychology about a recession, which has sort of been anticipatory for at least 6 months, going to manifest one? Or is there this mythical, possibly realizable soft landing where the economy tapers down in inflation, jobs remain robust, and wage growth remains not robust, but essentially good or solid? And can the president, who just declared his re-election campaign, say that his economic policies have averted a recession, minimized recessionary woes, and go into 2024 with the wind economically at his back? Or does all of this suggest things are going to get tighter and tighter, a recession is inevitable, and that lands in Q3, Q4, probably about the worst time for any president seeking re-election to have a recession that close to the re-election year he will be on the ballot for?
Yeah, and in some cases, that requires a bit of peering into a crystal ball to try and game out what the different scenarios could be. But Javier, to Major's point, what do you make of that soft landing idea that we're all hoping for?
We're all hoping for. It bears mentioning that we've been talking about vibes of the economy for at least a year now. Like last year, we spent a lot of time talking about the mood of the consumer, and the mood of the consumer is actually quite bleak. People are not terribly positive, even in the face of raising wages that have gone up, jobs that remain plentiful, activity that remains pretty robust. Consumers are sort of blah, and a big part of the reason why is inflation. So you've created this sort of dynamic. There's the need versus sufficiency, and the need is whip inflation now, sort of that old political saying. The Fed is really laser focused on that. The White House has sort of indicated that, look, they're an independent body. That is their mandate, price stability. They got to go after inflation, and it hurts. But the sufficiency is enough? And consumers, judging by how they feel now, and like a recession is all but an inevitable at this point, but we think that it'll more than likely be narrow, or it'll be a shallow recession, rather. We're not going to have some sort of 2008 crisis. But the banking strains that we've seen over the last several weeks and months are a real wild card, because if things pull back too quickly and too dramatically, what could be a soft, shallow recession could become something quite arguably quite worse.